Imagine a company that is currently dealing with just record-breaking, insatiable global demand for its flagship product.
Right, like we're talking massive wait lists everywhere.
Yeah, pharmacy shortages,
Right.
patients practically begging for access. I mean, basic textbook economics says that in this scenario, the company should immediately raise prices, right,
No.
to capture that demand.
Oh, absolutely. That's business one-on-one.
So why on earth did Eli Lilly just slash the price of their most popular drugs by nearly 10% and still manage to increase their net income by a jaw-dropping 168%?
Well, it completely flips the traditional supply and demand model on its head.
It really does.
And, it reveals a highly calculated, honestly, almost ruthless long-term strategy that goes way beyond just selling a product.
Welcome to our time in market deep dive. Just a quick reminder right at the top here, this deep dive is just for entertainment purposes, so please seek professional advice before making any investment decisions.
Always a good idea.
Definitely. So today, our entire mission revolves around the pharmaceutical titan Eli Lilly, ticker symbol LLY, and their absolute blowout Q1 2026 earnings report.
Which was just massive.
It was. We're going to unpack the mechanics behind their 56% surge in revenue, conduct a full financial valuation, including a 10-year discounted cash flow analysis, and, most importantly, examine the hidden vulnerabilities in their current market strategy.
Because when you are growing at this velocity and you're relying so heavily on, a single class of drugs, the ground beneath you can shift incredibly fast.
Exactly. So let's start by looking at the immediate market reaction to this earnings release because it was explosive. LLY shares popped 9.8% in a single day to close at $934.60.
Right, which is a huge move for a company that size.
Totally. And that completely reversed a trend that had the stock down, 21% earlier in the year?
Yeah, around there.
If you look at the performance through 2025 and into early 2026, it has been this roller coaster of regulatory news and supply chain fears. But this earnings call just blew the doors off the skepticism.
It really was a decisive beat. I mean, when you dive into the raw financials, Q1 2026 revenue hit $19.8 billion. That is up 56% year over year.
Wow.
Yeah. And if you look at their non-GAAP earnings per share, which basically strips out one-time accounting noises to show the core operating profit, it reached $8.55. Wall Street analysts were only estimating $6.79.
Okay, so let's unpack this from a pure valuation standpoint. Because whenever I see a stock nearing $1,000 a share on hypergrowth, I immediately want to know what the underlying multiples actually look like.
Naturally.
Right now, how does LOY's valuation compare to its historical baseline?
Well, it is running hot. I mean, very hot. If we look at the price to earnings, or PE ratio, it is currently sitting significantly above its 5-year historical average.
So the market is essentially pricing in perfection.
Absolute perfection. Even looking at the forward PE, which factors in these newly raised earnings expectations for the next 12 months, it indicates that investors are paying a very steep premium for every dollar of future profit.
Okay, let's ground that in some hard math for you. Let's run a 10-year discounted cash flow, or DCF analysis, to figure out what this company is actually worth on paper today. Walk me through the parameters.
Gladly. So to build our DCF, let's establish a free cash flow base of $12 billion.
Okay, $12 billion.
Right, which aligns with their recent operational cash generation minus capital expenditures. For a company of this size, projecting future growth is tricky, but given their pipeline, we will model a 9% annual growth rate for the next 10 years.
Hold on, a 9% annual growth rate compounded over a decade. For a legacy pharma company, that usually sounds, well, aggressively optimistic.
Usually, yes.
But given the metabolic boom we are seeing, that actually feels mathematically sound.
It does, yeah. It accounts for both their expanding market share and the inevitable pricing pressures they're going to face. Now, we apply a 10% discount rate to that.
Right, which essentially accounts for the risk of the investment and the time value of money. Basically recognizing that $1 today is worth more than $1 tomorrow.
Exactly.
Okay.
Finally, for the terminal value, which is what the company's worth in perpetuity after those 10 years, we use a standard 2.5% terminal growth rate.
Tracking roughly with long-term GDP growth.
You got it.
And when you crunch all those numbers, the $12 billion base, 9% growth, 10% discount rate, and 2.5% terminal rate, what does the model spit out for an intrinsic value?
It calculates an intrinsic value of right around $480 per share.
Wow. Okay, so with the stock currently trading at $934.60, it is trading at nearly a 100% premium to its calculated intrinsic value.
Yeah, it's a towering premium.
But despite that math, Analyst sentiment right now is overwhelmingly bullish. You look at the major desks, and they are constantly revising their price targets upward.
They are. And it really comes down to how they view the competitor landscape.
Hmm.
Their main rival, Novo Nordisk, is a formidable competitor, obviously.
Yeah.
But analysts believe Lilly's specific pipeline advantages and their massive manufacturing scale justify the premium.
Right. So if we had to deliver a final verdict based purely on the DCF valuation versus the current price, from a strictly fundamental value investing perspective, this is a hold.
Absolutely a hold.
The underlying business is phenomenal, but the current stock price offers absolutely zero margin of safety. You are paying top dollar for future perfection.
Yeah, you really are.
Which perfectly sets up the rest of our discussion.
Yeah.
Because to understand why investors are willing to pay that premium, we have to look at the engines driving that $19.8 billion in revenue. And I'm talking about the incretin drugs,
Hmm.
Mounjaro, which is approved for diabetes, and Zepbound, which is approved for weight loss.
Right. And just for a quick biological refresher, incretins are naturally occurring hormones in your gut that basically tell your pancreas to release insulin after you eat.
Okay.
These drugs are essentially synthetic versions that mimic that signal, making you feel full and regulating your blood sugar.
And mimicking that signal is, well, highly lucrative. Together, Mounjaro and Zepbound jointly generated $12.8 billion in global revenue in just one quarter.
Unbelievable numbers.
Mounjaro alone saw a 125% revenue increase. But this brings us back to the paradox I mentioned at the very beginning. In the U.S. market, Lilly's revenue grew 43% on a 49% increase in volume. But U.S. prices actually declined by 7%.
Yeah, that's the crazy part.
And without a one-time accounting adjustment for rebates, that price drop would have been 10%.
It is a deliberate, highly strategic move by management. In many therapeutic areas, insurance covers the vast majority of the cost.
Right.
So the patient is totally insulated from the list price.
Right.
But with anti-obesity medications, there is currently a very high out-of-pocket exposure for patients.
Wait, pause right there. That math still feels broken to me. If there are empty pharmacy shelves and patients are actively searching across state lines to find these pens, why not just hold the price steady? Why give up a 10% margin when the demand is undeniably there?
Because of a concept called operating leverage. I mean, think of their manufacturing process like a massive printing press. Building the billion-dollar facility and securing the regulatory approvals, that is the incredibly expensive, hard part. But once the machines are running, the cost of the plastic, the glass, and the liquid peptide for the millionth GLP-1 pen is just pennies.
Oh, wow.
Yeah, their profit margin on that millionth pen is virtually 100%.
Oh, okay. So the upfront cost is astronomical, but the marginal cost of producing one more unit is practically negligible.
Exactly. So in a market where patients are paying out of pocket, if you lower the price by 10%, you don't just capture 10% more patients, you dramatically expand the total addressable market.
Because suddenly people can afford it.
Right. You unlock millions of middle-class patients who couldn't afford the higher price point. The slight hit you take on the front-end price is overwhelmingly offset by the sheer volume of high-margin units you are suddenly pushing out the door.
That makes a lot of sense. But we also need to acknowledge that this strategy of trading price for volume isn't happening in a corporate vacuum.
Not at all.
If you or anyone you know has tried to get a GLP-1 prescription filled recently, you know the frustration of dealing with insurance hurdles. What you're seeing at the pharmacy counter is the direct result of a very intense global policy landscape.
Precisely. There are massive external forces basically compelling Lilly to accept lower prices. Let's look at the U.S. first. You have the Most Favored Nation, or MFN, drug pricing initiative implemented in 2025.
Right.
This requires aligning certain U.S. drug prices with international benchmarks. It effectively caps what companies can charge domestically based on the lower prices typically paid by European nations.
And then you also have the CMS Medicare GLP-1 Bridge program. Lilly finalized an agreement that extends this program through December 2027. It essentially caps out-of-pocket obesity drug costs like $50 per month for seniors on Medicare.
And, the dynamic is identical overseas. Take China, for example.
Yeah.
Mounjaro was recently added to the National Reimbursement Drug List,
Right.
or the NRDL.
Which is huge.
Getting on that list is a massive deal. It immediately makes the drug accessible to hundreds of millions of citizens. But the Chinese government negotiates hard. To secure that placement, Lilly had to accept a steep price reduction.
Wow.
Yeah, that single concession drove a significant portion of their 25% international price decline.
So it's a huge trade-off. These government policies limit Lilly's profit margins per patient, but they simultaneously lock in massive, heavily subsidized patient bases. Millions of seniors and international patients who would never have taken the drug are now taking it every single month.
It creates incredible predictable volume. But here is the critical vulnerability. When you sacrifice pricing power, you expose your broader portfolio to risk.
Yes, and that vulnerability is glaring when you look at the Inflation Reduction Act, or the IRA. While their new metabolic drugs are booming, older blockbuster drugs like Jardiance, Trulicity, and Verzenio are currently facing IRA-mandated price negotiations.
Right.
And once the government sets those lower prices, it will severely squeeze the profit margins on the legacy drugs that historically built Lilly's cash reserves.
Which means Lilly's only path forward is finding millions of net new patients for their metabolic pipeline to replace those lost legacy revenues. But they have a structural problem.
What's that?
You eventually run out of people willing to inject themselves with a needle every single week.
Right. There is a hard physical bottleneck. Which brings us to the science behind their newest product, Condeo. For the listeners tracking the clinical pipeline, Condeo, chemically known as orforglipron, is the newly FDA-approved oral GLP-1 pill for obesity.
And we really need to pause and appreciate the biochemical hurdle they cleared here.
Okay, let's hear it.
So, most GLP-1 drugs, like Mounjaro, are peptides.
Mhm.
Peptides are essentially small proteins. If you swallow a peptide, your stomach acid and digestive enzymes will immediately shred it to pieces before it ever reaches your bloodstream.
That is why they have always been injectables, right?
Exactly.
So how does Condeo actually survive the stomach?
Condeo is what's known as a non-peptide small molecule.
Yeah.
It is chemically structured completely differently from the natural hormone, which allows it to slip past the hostile environment of the digestive tract and still activate the exact same GLP-1 receptors in the body.
That's wild.
It is a genuine marvel of medicinal chemistry.
I hear that, but I'm going to challenge you on the market impact here. Because if you read the chatter from retail investors, a lot of people are pointing out that Novo Nordisk already has an oral pill on the market. Why is Condeo supposed to be this revolutionary catalyst if they aren't even the first to make a pill?
It completely comes down to the restrictions. Novo's pill requires you to wake up, take it on an empty stomach with a very specific amount of water, and then wait 30 minutes before consuming anything else.
Oh, wow, that's a lot of friction.
Yeah, and if you mess up the routine, the drug doesn't absorb. Condeo, on the other hand, is the first approved GLP-1 pill with zero food or water restrictions. You can take it at any time of day, with or without a meal.
Okay, that convenience factor is huge. And the early launch metrics from the earnings call back that up. Condeo is already available on over 12 major telehealth platforms. They've reached 8,000 prescribers, and 20,000 patients have already been treated.
Yep.
But here's the number that blew my mind. 80% of those Condeo patients are brand new to the GLP-1 class.
That is the most important statistic of the entire earnings call. I mean, they are not just cannibalizing their own Zep-bound patients who got tired of needles.
Right.
They're successfully pulling in the massive demographic of people who completely avoided the class because of injection anxiety.
But it gets even better, because Condeo isn't just a weight loss convenience play. We have to look at the Achieve-4 clinical trial.
Oh, the data there is incredible.
They compared Condeo to insulin glargine in type 2 diabetes patients. The results showed a 16% lower risk of major adverse cardiovascular events, which the industry calls MAE4. These are things like heart attacks and strokes.
And beyond that 16% reduction in cardiovascular events, the pre-planned analysis showed a 57% survival advantage.
A 57% survival advantage. I mean, you aren't just prescribing weight loss, you are prescribing a statistically undeniable reduction in all-cause mortality.
Right.
And here's the real aha moment for the business strategy. Insurers do not want to pay for weight loss. They view it as cosmetic. But insurers are financially obligated to care about mortality and preventing a $100,000 hospital bill from a massive heart attack.
Exactly. Lilly is essentially Trojan horsing an obesity medication into strict insurance formularies by proving it has undeniable cardiovascular mortality benefits. That is how you secure long-term structural reimbursement.
But, this dominance creates a glaring systemic risk for the company. If we look at the Q1 revenue breakdown, a staggering 65% of Lilly's total revenue comes exclusively from cardiometabolic health.
That is a massive concentration risk.
Huge. If there is suddenly a long-term safety scare linking these drugs to an unforeseen side effect, or if a competitor makes a sudden breakthrough with a totally different mechanism of action, 65% of Lilly's revenue is instantly vulnerable.
And management is acutely aware of this. This is where we see them deploying that $12 billion in free cash flow we mentioned in our DCF analysis. They are frantically building a safety net.
How so?
Well, just in Q1, they spent $3.5 billion on research and development. That's a 28% increase year over year. They currently have a record 42 active Phase 3 programs running simultaneously.
But they aren't just relying on their own labs. They are going on an absolute M&A spree.
Oh, big time.
Alongside a massive $15 billion share repurchase program, they recently acquired 4 different clinical stage companies: Orna Therapeutics, Centessa Pharmaceuticals, Colonia Therapeutics, and Ajax Therapeutics. And I want to spend a minute here because they didn't just throw cash at random startups. Why these 4 specific companies?
It is a highly targeted diversification strategy designed to break their reliance on obesity. Orna Therapeutics gives them cutting-edge circular RNA technology, which has huge implications for oncology and infectious diseases.
Oh, okay.
Centessa has deep expertise in orexin agonists, which targets neurological sleep disorders. Colonia specializes in gene delivery systems that could revolutionize how we treat autoimmune diseases. And Ajax Therapeutics focuses on highly specific hematology and oncology pathways.
So they are actively taking the windfall profits from their weight loss pens and just buying their way to the front of the line in RNA, gene editing, and neuroscience.
Precisely. They are building a moat of highly complex next-generation therapies. And, we shouldn't overlook the fact that their internal non-metabolic R&D is producing real clinical wins right now, too.
Really?
Yeah. Lilly's immunology, oncology, and neuroscience medicines collectively grew by 160% in Q1 compared to the same quarter last year.
Which is incredible. If a company grew its oncology division by 160%, that would be front-page financial news. It's just getting completely overshadowed by the Mounjaro numbers. You mentioned some specific drugs on the call, right?
Yes. For example, Iglis showed highly positive Phase 3 data for pediatric atopic dermatitis, which is a severe form of eczema with a huge unmet medical need.
Wow.
Additionally, their oncology drug, Jaypirca, significantly extended progression-free survival in patients with previously treated chronic lymphocytic leukemia. So the narrative that Lilly is just a one-trick metabolic pony is fundamentally incorrect. The incretin engine is providing the funding, but the rest of the fleet is modernizing rapidly.
Okay, let's bring this all together for you. Eli Lilly absolutely crushed the first quarter of 2026. They did it by embracing a counterintuitive, high-volume, lower-price strategy fueled by operating leverage. They successfully navigated restrictive government pricing policies like the Medicare Bridge program.
Right.
They launched Condeo, an oral pill that chemically circumvents the stomach acid problem and is already bringing tens of thousands of entirely new patients into the market. And behind the scenes, they are aggressively diversifying through targeted M&A to offset their heavy 65% reliance on weight loss revenue.
And that comprehensive execution is really why management felt confident raising their full-year revenue guidance to an estimated $82 billion to $85 billion.
Massive numbers.
Yeah, the underlying operational performance is robust enough to absorb the pricing headwinds they are facing.
Even with our DCF model showing the stock trading at a premium, making it a hold for value investors, it's undeniably an incredible story of a legacy company finding a whole new gear. But before we sign off, we want to leave you with a final thought to mull over, something that builds on the success of the Condeo pill.
Right. With Condeo successfully bringing in 80% entirely new patients, people who simply wanted the convenience of a pill without the friction of an injection, we have to ask ourselves a broader societal question.
I love this thought.
As these cardiovascular and metabolic treatments become as easy to swallow as a multivitamin, and as their mortality benefits force insurers to heavily subsidize them, what happens next?
It's a fascinating thought. Are we approaching an era where taking a daily metabolic modifier is just a standard, unavoidable part of human aging? Are we going to look back in 20 years and view a daily GLP-1 the same way we view taking a daily baby aspirin or having fluoride in our water supply? It really does seem like this company is charting an entirely new course for human healthcare. Thanks for joining us on this deep dive, and we'll see you next time.